Hey, welcome back everyone. This is going to be a margin update. I believe it's number 8. We're about 14 weeks into my margin experiment where I'm using margin correctly to generate real dividend income, for which I take that money and I flow it back into the margin debt, paying down the margin debt, ensuring that I have an appropriate amount of non-margin buying power, or what they call margin buffer, to never get a margin call. So the end result is I'm going to show you at the very end, as we collect a dividend, it pays down the debt. That's basically a free and clear share or shares that I'm earning. Yeah, that's right. We're going to talk about using margin, but I'm also going to talk about how people have this perception that margin is a bad thing. I'll go on all these Facebook groups and inevitably somebody will ask the question, does anybody use margin for dividend investing? And I will tell you, the comments will scream, no, no, no. And they'll give you every single reason in the world as to why not to use margin. But otherwise, for the most part, I'm going to make a compelling argument in this video for which we compare credit card debt to margin debt. You're going to have a clear and concise picture of what could be for you. Now, also at the end, I'm going to show you how much I've made in those 14 months, where I'm at now, and we'll finish it up with a peek of the margin calculator for which you want to use to set up your very first using margin for dividend investing trade. So look, if you like anything you hear today, I want you to subscribe to the channel. I try to come back and up your game. You know, we went on margin 14 weeks ago, largely because I had folks wanting me to do it and document it. There's so many people on YouTube that are so scattered. They come out with a video that has great content, and it isn't but the next video. They find themselves in a bad way. They've done things wrong. And all of a sudden, if you're trying to follow that person to use margin, it's destroyed because you don't know where they're at and you have no confidence they're going to stick to the plan. Remember what I always tell you here at the channel. We have a plan, we execute the plan. And that's what I've decided to do for these past 14 weeks. We execute the plan and we're going to document it. There's no hocus pocus in these numbers. I literally bought a dividend paying stock on margin at the absolute high. The market crashed. We had to deal with that. Then we shifted out of one dividend paying stock to another. We documented all this, and that's the purpose of this video experience. This is my journey to be consistent so you can feel I'm bringing you an honest representation of how to use margin for dividend investing smartly. Now, hey, look, if you like this video today, bang that like button. It lets me know you like what I'm doing. Now, what we're doing is this. We are going to focus on the screen here. Now, I'm going to point out a couple things, and I think this is Mr. Obvious, but the one thing I really want you to highlight, when we talk about debt, this is all about debt, right? And when we use debt to buy things or go on margin in the stock market, we're taking on debt. We're taking on the liability that somebody else has given us the right to use money we don't have. So I love the compare and contrast with credit card debt and margin debt. I'm going to tell you the reason for this is because when I listen to all the naysayers in the comments and they're just screaming, just running out the door on fire saying, never use margin. It's the devil. Yet they will go and spend money on a credit card like it's nothing. That credit card is racking in non-cash producing debt. That's what I'm going to show you today. That's absolutely, completely reverse of what using margin will do for you. I just love how people will say, oh my gosh, I'll never use margin. And then they pull out their credit card and buy lunch, buy groceries, buy a vacation, buy all the good things in life, racking up debt. And you know how they pay for it? They pay for it by going to the 9 to 5. As if the 9 to 5 is more secure than one of these dividend paying funds paying their dividends. I'm going to tell you right now, your job is about as secure as the company you work for. And what I mean by that is nobody's loyal anymore. So when you rack up all that credit card debt and you're hoping that the 9 to 5 pays for it, well, you're not earning any sort of interest or dividend on that money. So you're literally racking up credit card debt and you're taking away family vacations, family dinners, family getaways, because you have a positive cash flow from the 9 to 5, but then it's getting taken out by the negative credit card debt. You're never getting ahead. You're spinning your wheels. Now margin enters the room, but we're not using margin like most people think. In the past, people have used margin to buy a stock and they hope it goes higher. Well, that's where they get broken off because you have to pay margin debt. And it's paid monthly. It can be as high as 12%, depending on your margin interest rate. Now, what I'm going to tell you is this. That margin debt you just took on, if you buy a dividend-paying fund that we're going to talk about, pays down the debt. See, that is the 9 to 5. You don't have to do anything. The dividend-paying fund is paying down the debt. But here's the deal. What do you have at the end? I'm going to show you what you have at the end, because what you have with a credit card is you have non-cash producing assets that, quite frankly, depreciate the second you buy them. Whereas when we use margin and we use that dividend to buy cash producing assets, well, those cash producing assets are going to pay you cash for as long as you keep the dividend paying fund. Now, look on screen. I'm going to bullet point some good things here. Notice interest rates. A lot of people say, well, you pay high interest rate with margin. That's completely wrong, because when you buy on credit card and you do not pay your credit card off, that would be 18 to 30%, mostly 20%. Using margin to buy a dividend paying fund, you're going to pay anywhere between 6% and 12%, but we know we can negotiate our rate down. Try to negotiate your credit card interest rate down. Yeah, it's not going to happen unless you go belly up and you have to call them saying you can't pay your bills. In the case of margin, we can actually negotiate our interest rate down. Now, cash flow potential. I love this one because this is in the comments where everybody's just flaming the hell out of margin and using it and this, that, and the other. But yet they're using that credit card to buy non-cash producing assets. Your purchase doesn't generate income. You basically pay for it, and what you're hoping for is the 9 to 5 pays for it. You're putting more trust in your 9 to 5 to pay for that debt. Well, here's the deal. When you go on margin by a dividend paying fund, that asset pays you back. The asset can generate income to help pay off the margin interest. And what are you buying at the end? You're buying an asset that could appreciate, and for the most part they do, but they pay monthly cash back to you. Doing nothing. With your credit card purchase, that's a non-cash producing asset, and it depreciated the moment you bought it. Now, I love looking at debt behavior. Because here's the deal. We have the credit card that absolutely encourages spending in this economy. It really does. I mean, they are sending out credit cards to kids that aren't but 2 and 3 years old. And I'll tell you, it is incredible how people will take on debt and not even think about it, because what they think about is, oh, if I buy things on my credit card, my monthly credit card bill is $20. Well, that's where they're paying that 18 to 30% interest. Again, for a depreciating asset, they might go out and buy things that, quite frankly, might be gone by the time you have to write that check to pay the credit card. I'll tell you, at the end of the day, you're hoping the 9 to 5 pays for all of that. Again, you are putting your trust in your 9 to 5. I'm going to tell you right now, there are companies out there that have zero loyalty. I'll never forget a conversation I had where we talked about when you buy a house, the banks want to see debt to income, and that income has to come, for the most part, from a 9 to 5. Yet here you are with dividend paying assets. Well, the bank doesn't want to see that. For some reason, they think that 9 to 5 is more trustworthy in paying your bills than dividend paying stocks. Let me ask you a question. Which one do you think is more loyal? Microsoft and them giving out their dividend, or a 9 to 5 that, quite frankly, could move you out at any point? That's why I love how margin debt, getting back to margin debt, it encourages investing. And that investing is in appreciating and income assets. Look, every time I write a covered call and sell a cash secure put, and I have a profit, it encourages me, promotes me to take part of that profit and pay the taxes. I then buy a dividend paying stock for which is going to sit there all year. And it's going to grow and grow and grow. And when the tax bill is due, I'm going to sell that asset to pay the taxes. It encourages me to invest. It encourages me to get smart about buying cash producing assets. When you use your credit card, it's like so flippant. We go to the grocery store, we go to dinners, we go to the breweries, and we just use it. And then we put it in our wallet. We don't think about it. Then the bill comes. Well, in the case of the credit card, you're going to have to pay it. You're going to have to transfer money. You're going to have to scratch a check. Hell, some people are using a credit card to pay a credit card. In the case of margin debt, you know when that dividend comes in, the margin interest debt that you owe every single month, they just add it to the debt for which the dividend paying fund is going to pay down. Now, let's talk about financial leverage. We got bad debt. That bad debt subtracts from your net worth with the offset of the credit card usage. Whereas using margin potentially is good debt, if you buy a dividend-paying fund that is reputable, it's used wisely because it can build wealth via leverage, and we're buying a cash-producing asset that produces cash flow every single week. Look, I know some of you are saying, look, man, you're cherry picking between the two, but the point I'm trying to tell you is, in life, we want to buy cash producing assets. Forget all of this. What I'm saying is, if you're going to say that debt is bad, debt is the devil, then don't reach so quickly for that credit card. Now, let's finish this video up. Boy, I'll tell you what, at the end of this video, you have a chance, the Smart Guide to Using Dividend Investing and my margin calculator, and you're going to see that the phone app has all of that. We have videos for which document all of my journey using this. Now, here we are. We started this way back February 28th. Remember I bought QDTE? I bought it at the absolute high of the market. So what I did, and those videos, by the way, document all of this, I wanted to make sure I had a great margin buffer. I did not want to test a margin call. So we went ahead and left ourselves about $20,000 in potential margin buffer. They call that non-margin buying power. So I had about $20,000. I literally buy QDTE at the top, man. It is the top. You talk about bad timing, and then it crashes. Now, I'm down $18,000 on the position. But you know what? My margin buffer was not even tested. My margin buffer went from 20,000 down to 14,000, and then the markets turned around. The whole time, we're generating the cash flow you see in the middle. We are generating on 2,000 shares, $500 a week, $300 a week, $450 a week, $550 a week. It's coming in. The cash flow is paying down the debt, and my non-margin buying power is increasing. Because remember how it works. I have my debt, and as I pay into the debt with these weekly dividends, it's actually increasing my non-margin buying power or paying down the debt. Or if I'm able to get out of QDTE at my cost basis, all of that money just bought me a cash producing asset. QDTE equivalent shares. Now, we go ahead and shift out of QDTE for one reason. We're able to take a tax harvesting moment when we sell out of QDTE. $18,000, I'm in the hole. But we immediately roll into IWMY. Now, we take on the same margin debt. We do not add, we do not do anything. Same margin debt, we're able to buy 2,700 shares. And we're in the game. We don't miss a dividend, we are moving. Now, all of my covered call profits has an $18,000 tax harvesting credit at the end of the year, and I'm still working this margin using dividend paying stocks for this journey. Now, I'm able to pay the margin debt you see to the far right. So right now, I have generated $6,752 in pure dividends if you pay the tax man. And that's what I like to do. I like to take profits and then pay the tax man. And I know some of you will say, well, it's in an IRA, I don't have to pay taxes. Okay, I'll show you a screen here in a minute. And some say, I don't even pay taxes because this has return of capital, blah, blah, blah. Look, condition yourself. We condition ourselves. We make a profit in the stock market. We take 25%, move it to the tax bucket. The tax bucket could be a dividend paying fund. I use XDTE. XDTE in my account equals taxman. I pay the taxes with my XDTE. Now, that's what I do. I condition myself. So now every single profit will always have me buying a dividend paying fund, cash producing asset. See, this is the wealth mindset. If you're out there spending your credit card thinking margin's bad, I'm telling you, you have the trade mindset, the cash mindset. You don't have the wealth mindset, the passive income mindset. Come to our side, you're going to see that this is incredible. Now, what if we're not going to pay the tax, man? Check this out. If we do not pay the taxes because it's in an IRA, we would have generated $9,000. And we would have paid $669 in margin interest debt. Now, that's going to be there every single month, but it is around that amount. Now, look at the numbers. The numbers are coming in. We're taking on debt. We're paying the debt down with the weekly dividends, and we're paying down the interest, for which we're using other people's money to build wealth. That's the key here. We're building wealth. You see the track record. You see what's happening. I'm going to hold this for potentially 2 years because it's going to pay down the debt and I'm earning all of these shares for free. So the absolute secret to using margin, well, the dividends feed the margin debt. That's your 9 to 5. Dividends is your 9 to 5, but yet you don't have to work. So you got your margin debt, you get your dividends, the dividends pay down your debt, so you have less debt. You did nothing. Look at the bottom. Be the person who uses margin to grow wealth while others rack up consumer debt and liabilities. Now, what is the end game? The result is free and clear shares, knocking it down, paid for by the dividends. That's how it is. Once this debit is cleared, that's what happens. And I'll tell you another thing that happens. This turns out to be free and clear weekly cash flow. See, we buy dividend paying funds to pay down the margin debt. Think of it this way. We take on the margin debt responsibly. We buy a cash producing dividend fund, which when we collect the dividends, pay down our debt. Now, we're making more in dividend income than the interest we pay. So in this case, I've been on margin for 14 weeks. I've paid $669 for using somebody else's money. I've made over $9,000 in dividend income. This is how you use margin smartly. Now, below in the description, if you want the smart guide to using margin for dividend investing, I have like 18 chapters talking about everything from how to use margin, how to negotiate down your margin rate, and all the other stuff that comes with using margin. We also have a chapter on NAV erosion. Very important. I want to educate during this process. This is why I created the smart guide to using margin for dividend investing. I created a tracker for which I used. So I'm tracking my progress, knowing when I made a profit. I also created the calculator. You have to have your initial trade set up so you know how profitable you're going to be. I even threw in worst case scenarios. Everything about the margin calculator is about me using margin, finding myself in different situations over the past 14 months, and I created those tools inside the margin calculator. Now, inside the margin calculator, you have all the update videos for which I will constantly update while I'm in this process, and you have all of that. All you have to do is click the link in the description below to get all of this. I'll absolutely tell you now, if you're going to do this, you have to be responsible. Buy a dividend paying fund. I need you to use the initial trade setup so you know when you're profitable. Then I want you to run worst case scenario trades because we could have another market that slams down and I want you to avoid a margin call. That's what we're trying to do here, avoid a margin call. And that's what I try to educate and create the tools for you. Hey, look, I wish you the very best in your journey using margin for dividend investing. It can be profitable, but I'll also tell you this, it could be long-lasting cash flow for life. because when we pay down this margin debt, we are buying cash producing dividend funds that will pay us for life. Hey, look, be safe, be healthy, most important, be lucky. Until next time, may all your covered calls be profitable.